On this report, I would like to review the latest post, the latest report that we published in Seeking Alpha on October 23rd, 2017 by our research director, Scott McDonald. In this report, we review the 18-year cycle, which is telling us that it's intact and gold is about to embark on the next leg up. The 9-year gold cycle also indicates a long-term buy signal. The 12-month supply and demand outlook is bullish for the next year. Factors that favor gold today include negative interest rates in gold mining companies, reduced operating costs, and capital expenditures. As we take a look at the 18-year cycle, we see that the long-term secular bull market in gold is intact once again and about to embark on this next leg up. This leg is projected to take gold to new all-time highs. Despite several pullbacks, the price has held above the long-term 50-month simple moving average SMA of 1235 for 3 consecutive months for the first time in 4.5 years. The long-term 18 SMA is at 1270, closing above the long-term 50 SMA of 1235 has activated a major long-term buy signal and resumption of the secular bull market that started 18 years ago in 1999. A head and shoulder bottom formation supports the long-term 18 and 50 SMA major long-term buy signal as well. We also looked into the 9-year cycle. The 9-year cycle 18 SMA is also at 1270. Closing above the 50 SMA of 1235 has activated a major long-term signal and resumption of the secular bull market that started 18 years ago in 1999. We took a look at the 12-month supply and demand outlook, and pretty much in my last report published in Seeking Alpha, I argued that based on the EMA to trade live analytics proprietary variable changing price momentum indicator, the VCPMI, the long-term trend momentum for gold is bullish, with targets of 1386 to 1484. According to my analysis, you can use the extreme above the mean as your target, which is 1386 to 1484, and is the sell 1 and sell 2 levels. We recommend easing out of long positions at the sell 1 and 2 levels as you take profits off the table. If the market closes below 1264, the market momentum changes from bullish to neutral. And if that happens, you should cover any bearish position if you've taken, since the sentiment will change toward the levels of 1166 to 1044 as basically levels of buying recommendations in covering shorts. The market may not go down to such levels, but a move to 1264 means that you should be alert to the possibility of lower prices. Now, we took a look at some fundamental factors that basically affect the price of gold, gold stocks, and ETFs. According to SprotsETFs.com, gold stocks and ETFs provide investors with access to innovative and unique indices that are designed to outperform passive market cap-weighted offerings. Negative interest rates have historically been supportive of the price of gold. In Q3 2016, there was 11.6 trillion in negative yielding bonds. In response, there has been a significant sentiment shift in favor of gold. ETFs dealing in gold posted significant increases in fund flows with ETFs accounting for an increase of 18.3 million ounces year to date. Historically, in gold bull markets, gold equities have outperformed gold bullion. The ratio of gold equities to gold today is less than half of its historical average. During the recent gold bear market, gold companies reduced their operating costs and capital expenditures. All-in senior sustaining cash costs have declined 24% from $12.27 per ounce in Q2 2013 to $930 per ounce in Q2 2016. In a rising gold price environment, gold stocks have the potential to provide additional returns because the value of unmined gold reserves increases, making gold companies more valuable to investors. The profitability of gold companies can rise exponentially relative to the price for gold. In this case, it shows a net profit of $450 million, which in this illustration is an 18% increase in the price of gold, translates into an 80% increase profitability for the company. The average 24-month return for gold stocks following the market bottom of the last 7 bear markets was 117%. So we've come to the conclusion that based on the data points and information above, we can conclude that the gold market is in basically the early stages of a potentially powerful upside move. Gold will probably revert back to the average price of $1,420, which is the 4.5-year target, the halfway point in the 9-year cycle that started in 2008. Closing above $1,420, the equilibrium price, or the mean, activates the 1789 to 2293 targets at the extreme above the mean. An initial close below 1264 would neutralize the current uptrend, and a second close below 1264 opens the possibility of testing the extreme levels below the mean of 1166 to 1044. Such a downward spike is highly unlikely to happen, but if it does, it would create the best buying opportunity in precious metals in a decade. Disclaimer: the information in the market commentaries was obtained from sources believed to be reliable, but we do not guarantee its accuracy. Neither the information nor any opinion expressed herein constitutes a solicitation of the purchase or sale of any futures or options contracts.